So Nvidia is set to report its third quarter earnings. This is after the bell today. Analysts are expecting the company to post an EPS of $1.25 per share on $55 billion in sales, which would mark an increase of 56% year on year. When it comes to order numbers, these will also be in focus, particularly after the CEO, Jensen Huang, surprised the market last month, revealing that Nvidia had $500 billion worth of orders for this and next year combined. Now, investors will also be watching out for any commentary on sales in China after Huang made a deal with the President Donald Trump to obtain export licenses in exchange for sharing 15% of the revenue with the U.S. government. But there's more. Other things in focus include deal making. Earlier in October, Nvidia took a $1 billion stake in Nokia, which would allow it to integrate its GPUs into the telco's cellular network hardware. The company also pledged to invest $10 billion in OpenAI, as well as $5 billion in former rival Intel. And this comes after a survey by Bank of America suggested that a majority of global fund managers think companies are over-investing into AI. More than 50% of the fund managers surveyed believe that AI stocks were already in a bubble. And it comes after Barclays estimated that AI-related investments by both hyperscalers and smaller companies could reach the equivalent, listen to it, of 10% of US GDP in the next 4 years. So we're talking about unprecedented numbers here. Let's discuss some of these market developments with our next guest. Richard Kelly, Head of Global Strategy at TD Securities, is joining us this morning. Richard, great to have you on the show. I'll start the conversation by getting your thoughts on these ongoing concerns around AI valuations. What do you make of that?
I mean, there's certainly a large chunk of financing that's been going on. There's certainly a large share of the investment growth that's been going through over the last couple of years that's built up. And this is where if you start extrapolating things out many years into the future with no changes, you can see something go through there. But I think if you just look at the GDP numbers themselves, we don't find much accounting that the AI investment that's going on is driving a significant share of actual GDP growth. For one, you get a large part of imported content. For another, if you look at the crowding out that's going across other investment, this is an investment that's happening on top of everything else that would be happening otherwise. It's crowding out a decent share of that investment. So I think at an aggregate level within the economy, it's not having that large of an impact yet. And a lot of the potential comes from productivity growth. And that's something that's going to come much further in the future as well. So I think this is one that there's certainly concerns to look at the structure and how the funding looks like within the market side of things. But I think some of the discussions when we try and extrapolate into the economy right here is a little bit overblown.
So that's when it comes to potential economic ramifications here. But if you focus on the markets for a moment, there seems to be two schools of thought. One suggesting that the sell-off we have witnessed is different from the ones we have witnessed in the past and are just the start of a broader concern in terms of the outlook for AI. And the other school of thought suggests that this is just a healthy correction. In which camp are you on at this stage?
I think if you look at it more fundamentally, I mean, we look at it from the data. And obviously, one issue we've had for the last month and a half, for 2 months, is we haven't actually had any data to anchor expectations. So we've had to look for other things in markets to try and see what's going on. We've had to look at alternative data going through. If you actually look at macro consensus, you actually look at data surprises, and you see where equities have traded, you have seen a divorced move. You have seen equities trading well above the data we were getting, but we know we were missing the data that markets want to go through. So I think there's been some front running of what sort of strength there is. And I think over the next couple months, as we see the backlog of US data come through at the very least, I think that gives you a sense, unless this data can surprise significantly to the upside, you probably have had a little bit more sentiment come into risk assets than there probably should have. And we'll see how this sort of cascades through.